Hello everyone and welcome back. Listen, today I want to do something special for you. All right, I want to talk about payday loans. Don't be intimidated. Watch this. Payday loans have long been termed predatory lending. But are they really that bad? Sure, you may have some high interest rates, but what's the real reason people are getting into deep financial difficulty with these types of loans? And could these types of loans be better than you think? You see, I understand. When a person gets into a situation that's unexpected, they need a source of funding that sometimes they wouldn't be able to get at a bank. The reasons are various. So let's say their credit is still being built, and so the bank turns them down for a loan. Okay? Where are they going to go? I'll tell you, to someone who will lend them money, regardless of how much their credit needs a little boost or improvement. Okay, many times these lenders charge higher interest rates because interest rates reflect the risk they are taking with a certain consumer. Let me say that again. Lenders charge higher interest rates because interest rates reflect the risk they are taking with a certain consumer. So the consumer gets the loan, right? And the lender gets the promise from that consumer that they will fulfill their wishes and pay the loan back with many times massive, sometimes massive interest. But is there a way to cut that interest drastically? You can bank on it. The best thing you can do with a payday loan is go out and get a secured line of credit with it. That's right, I said it. Get a secured line of credit with that payday loan. Then start using your line of credit as your new checking account, ensuring that you will leave positive cash flow every month. Now, if you need to get a payday loan, some will call it installment loans, I'd like to recommend a course of action that you can take to literally save you thousands of dollars in interest if you have to deal with those humongous amounts of interest rates. Are you ready? All right, let's go. So instead of borrowing $1,000, okay, I want you to watch this now. Instead of borrowing $1,000, borrow $3,000 at 200%. Now, I know that seems outrageous, right? But I want you to listen to what I'm going to train you today, because this is very, very valuable. Borrow $3,000 at 200%. What are you going to do with that $3,000? You're going to go out and get a line of credit. Then, with the money they just gave you, watch this, from your line of credit, let's say that $3,000 is at 21%. You're going to pay $828.60 from where? Your line of credit with what? The money they gave you, okay? $828.60 towards that payday loan. You will arrive at the number $2,671.40, okay? Month 2 will come around and you'll say, you know what? I don't like this number because I know that the interest is going to feed off of this big number. So I want to cut this number in half. So I think I'll take the money that they gave me in my line of credit and I'm going to put down the $1,335.70 towards this principal, so that now the principal is at $1,335.70. Remember, we're still on month 2. So you got month 2 and you're like, well, what does month 2 look like now that the principal is $1,335.70? Okay? You're still going to pay $828.60. You know that, right? Absolutely. Just because we take a big old chunk of that principal doesn't mean we stop those monthly amortized payments. Okay? It's still going to be $828.60, but look at this. Look at how much is going to the principal. $605.98. Whereas before, only $328.60 was going there. What happened? The tables have turned. That's what happened. We cut down that principal. That's what happened. So now we're at $729.72 month 2. Well, what happens month 3? Well, month 3, of course, you're still going to pay the $828.60. However, look at the principal. $706.98. What in the world? Are you serious? Do you mean to tell me I paid off $3,000 in 3 months? Well, CJ, how much did it cost me? Oh, it cost you. It cost you. Look, $844.24. If you take this interest, the $500, the $222.62 in month 2, and the $121.62 in month 3, it cost you $844.24. But if you would have taken the old route and used your checking account, okay, instead of the line of credit, using your line of credit as your new checking account, guess what? You would have had 6 months to pay that joker off, and you would have spent $1,971.60 in interest. So using this method, you saved yourself $1,127.36. I didn't forget. I know the line of credit. We got some interest there as well. If you kept that balance on there for the whole 3 months, $1,335.70 at 30% interest, that's kind of high, right? But so what? It's simple interest. You would have paid $200.35 in that simple interest. So let's add it up. $844.24 plus $200.35. We come to a total of $1,044.59. So my question to you is, how much did this loan cost me? $1,044.59 to get $3,000. Any questions? Now make sure your lender, right, your payday loan, make sure that they allow you to pay the principal. Okay? I have no clue why they wouldn't, right? But different states are different ways. But it costs you $1,044.59 for a $3,000 loan. And you say, well, CJ, wait a minute. Remember, we still have our credit card. We still have our line of credit that we have to pay back. Remember? I sure do. So let's say you have, what, $7 left? Huh? You got like this enormous balance. How does that get paid off? How does that get paid off? That's right, by your income. Okay? So you're going to place all of your income inside of your newly formed line of credit, thanks to the payday loan, guys. Thank you so much. Right? You're going to place your income there, and you're also going to pay your expenses from there. And so let's say you have a $200, right, cash flow, right? Let's say you have a $300 cash flow, maybe even $1,000 cash flow. That's what's going to pay that balance off. You don't have to do anything special. Nothing. You don't have to do anything special. Just keep on paying, right? And then pay those expenses. Get paid, pay those expenses. Get paid, pay those expenses. Okay, does that make sense? All right, let's go ahead and go over it one more time. Then I'm going to issue a challenge to you, all right? $828.60 each month. That's not going to change. Why? Because it's amortization, all right? And if you would, please divide the top number by 2. That way, your interest is cut dramatically like we've seen, and you get that loan paid off in 3 months instead of 6 months. All right? Listen, paying and chunking the principal is one of the most important elements you could do within the velocity banking method. Make sure any lender will allow you to do that so that you can go forth and prosper. Let me tell you, this is amazing. And if you have any questions, don't hesitate. info@velocityc.com. I definitely want to hear from you. We have financial software now, absolutely, that can help you with any loan, with any debt that you have. Just let me know if you're interested. We'll schedule a call with you and we will look at your strategy. We'll put something together that is, right, fit for you, and you will see how powerful this method is. Listen, folks, I don't have to convince you. That's what I love about the numbers. The numbers will convince you. God bless, and you have a great night.